Fantastic. So, local authority debt. Now, I guess, yeah, this is an issue I've sort of been looking at personally, and we've been looking at with Druck for the past 3 years. So we've gone from being complete novices knowing nothing to somewhat kind of expert. But if there's any sort of issues I kind of bring up and aren't clear, please jump in, ask to clarify. We'll try and avoid using jargon as much as possible, but talking about finance, sometimes that's difficult. So if you don't understand something, please stop me and I'll try and make it sort of, more clear for you. So, okay. Hang on, where's,
No, I think you need to go on the presentation.
Okay, right.
Yeah.
And you just scroll down.
Yeah.
Cool.
Is it working?
Yeah, perfect. Yeah, so Fanny's explained a bit about Debt Resistance UK, what we're set up to do, so I won't kind of dwell on this. Basically, our aim is to kind of raise the profile of issues around debt, how it affects, overall society, and more importantly, what as individuals and as civil society we can kind of do about it. So how we politicize the issue of debt, take it out of the shadows and make it more of a kind of mainstream issue people feel they can take action against. One of our aims is to think about how our research on debt would be useful for other campaigns. So for instance, we were just hearing about housing in Hackney. So how is it that local authority debt and high interest rates being paid by councils mean there's less money available for social housing, for council services, and what can we do about these things? So I guess we'd like to collaborate with other groups looking at local authorities. And so if there's sort of obvious crossover you see between the work you're doing and what we're doing, we'd love to talk about that at some point today. Basically what we've been trying to do over the past couple of years is to obtain information on local authority borrowing from banks using freedom of information requests, and to put that information available online so people can understand how their local authority is financed, how much money is being spent servicing interest on that debt, and understanding how and why those loans were sort of taken out. I won't talk too much about that now, I'll come back to it later on, but the idea is to make all the information available open source online so people can see clearly what's going on at the local council level. So in terms of the work we've been doing to audit council debt, the political context for local government is really important, right? So since 2010, with the austerity cuts that have been put in place to pay for the bailout of the banks during the financial crisis, by far the largest level of cuts to public spending has been local government. Between 2010 and 2015, that amounted to about a 40% reduction in central government funding to local authorities. By the end of the decade, it will be up to around 60% relative to what they were being funded in 2010. So basically, local authorities as we knew them a decade ago will almost cease to exist. They'll be stripped down to bare minimum of service provision, and we're already at a point now in 2017 where about a third of local authority CEOs think councils will be bankrupt within the next 12 months. So councils are in a particularly dire financial position because of the fact that government has effectively defunded them. And so basically what's been happening while the sort of cuts have been sort of handed down, local authorities have been trying to make up that shortfall in funding by borrowing more money. So if you look at this chart here, the light blue line on top, you can see is council borrowing, and this is for Scotland. And you see that when the dark blue line starts to dip down, you get a corresponding increase in borrowing. So generally the rule of thumb is that whenever there's cuts to local authorities, they have to make it up either by borrowing more money or by selling off public assets. And in this case, they're having to do both. Okay, so I guess just a little bit of kind of economics for you. This guy here, his name's Professor Michael Hudson, one of my sort of intellectual heroes, I guess. He talks a lot about unearned income or rents, and this is something which has been largely ignored by economists over the sort of past 20, 30 years. And so I guess today, just to point out, we're talking about interest, which is effectively rent on money. So we're talking about banks, we're talking about loans from banks, and we're talking about comparing the interest rate on those loans, which banks charge, and comparing the interest rates to the rates on government loans. And so that's, yeah, one of the key things we're looking at today. A great example of local authority debt is Newham Council. We've got several Newham residents here today, which is great. Newham, if you sort of look at this chart, went on a bit of a borrowing binge in the mid-2000s ahead of the Olympic Games. And you sort of see that there is an almost kind of build up of debt now. Unfortunately, the chart's chopped off a little. But the years here are, say, I think 2006 for the debt for loans through to 2009 for the Royal Bank of Scotland on the right-hand side. So Newham basically borrowed more than £500 million from the banks in the space of about 5 years. Primarily from Barclays, about half that amount is from Barclays Bank. Second largest lender being the Royal Bank of Scotland, RBS, after it was bailed out by the government in 2009. Now, the interesting part of this issue of LOBO loans is, as I mentioned, looking at the interest rates on the loans relative to a government loan. And about a year ago, Debt Resistance UK was involved with Channel 4 Dispatches in doing an investigative piece looking at this issue for TV. And residents in Newham were sort of asked how much they thought the council would be able to borrow from banks. And they were basically given a couple of reference points. The first was the current Bank of England rate, which was at the time 0.5% interest, which is the Bank of England base rate. And they were asked to think about their own personal mortgage and think about the council and sort of say, do you think the council, the rate it would borrow would be higher or lower than your own personal mortgage rate? So the average person who was asked this question was sort of thinking, well, maybe the council borrows at like 2-3%. My mortgage is probably like 4 or 5%. Surely it's going to be lower than that. And most of the residents were shocked to hear that the council was paying as much as 7.6% on the loans they're taken out from the banks. And the obvious question is, why is this happening? This was some sort of coverage of the issue in the Financial Times early last year by Jim Pickard. He looked at what's called the face value of the loans, the amount they took out, 563 million. And then compared that with the amounts in the council's financial accounts at the end of the year, which was 959 million. And the reason there's a difference between those two is effectively because interest rates have dropped since 2008-09, and the costs of breaking out of those loans or cancelling the contract has increased significantly. So the face value or the carrying cost of those loans has shot up, and at the moment, we think that breakage cost for Newham is somewhere around about £1.3 billion if they were to try and buy their way out and cancel the loans. So this chart looks at the cost of servicing debt. So the amount the local authority is spending in interest payments relative to the income the council gets from council tax. So the amount you or I pay if we live in the borough, that goes as a local contribution towards services. Now, Newham is by far the worst. This chart is basically, there's sort of 20 or so local authorities where objections were raised to LOBOs in the past 12 months. At Newham, 80% of council tax or equivalent is going towards paying debt interest, both to banks and to government. Across London boroughs, the average is about 23%. Just as a kind of comparator. For Scotland, about 43-44% of council tax on average is sort of soaked up servicing debt interest. And as you can see, there's an extraordinary amount of variation between the councils, partly because of economic factors, how many people live there, how big the council is, and partly because some of the councils don't have a lot of debt, particularly county councils in the shires. So talking about the cost of borrowing, we did some analysis at Newham and sort of looked at the amount they're spending in interest payments each year relative to the cuts that the council was saying they had to make to basically account for the fact that their funding from central government was being cut. And what was interesting about it is you look at the amount Newham was saying they had to save each year as part of the austerity cuts, 50 million, and turns out they're paying 51 million pounds a year in interest on these loans, which is quite a kind of neat comparison of the sort of scale of this borrowing and how much money is being soaked up in servicing bank interest. This looks at how much Newham spend on interest to the banks relative to public service provision. So again, unfortunately, labels aren't coming out so well, but here we've got adult social care, children's social care next door, and we've got bank interest, blue to black, and then to the right, environment and regulatory spending, public health, and at the far right, housing services. And I think what's interesting for me is that Newham Council has one of the highest rates of homelessness in the country. It's one of the poorest boroughs in the country, and here they are spending more money on bank interest than they are on housing services, which sort of prompts the question of what's the council actually for, and why is it that so much money is going to pay financial firms rather than going to service provision, which is where it's supposed to. So this is a report which came out end of last year, something like 12,500 homeless people in Newham, most in England, 1 in 27 residents in the borough. Crisis levels of homelessness, which both the council largely tries to ignore. So I guess, the question you get to is, okay, councils have got a lot of debt, they're paying high interest on these loans, but how do we get to this point? Why do local authorities, why have they been encouraged to borrow from banks? How did this all come about? There's a really interesting precursor to LOBO loans, which sort of came out in the late 1980s after deregulation of the City of London, the Big Bang. And basically what happened was a large number of councils, including Hammersmith and Fulham in London, were encouraged to take out speculative bets on interest rates using interest rate swaps. And so at some points in the late 80s, auditors were kind of flagged up to the fact that councils had amassed billions of pounds of financial liabilities using interest rate swaps. And Hammersmith and Fulham was sort of the basket case, which became the sort of poster child of this sort of scandal. But effectively, at one point, the government was worried Hammersmith and Fulham might become bankrupt because it has sort of taken on board so many of these swaps. And so objections were mounted by local residents with the help of the Audit Commission, and there was a series of legal cases which followed. Ultimately, what happened was that it was deemed to be ultra vires or illegal for the council to speculate on interest rates, because that wasn't their core purpose. Councils are here to provide services, not to speculate in financial markets. And so the contracts were declared illegal and they were unwound, and basically everyone got put back to the state they were in before they took out the contracts. As you can imagine, the banks weren't particularly happy because they lost a whole bunch of money. But as a result, Hammersmith and Fulham didn't go bankrupt. And as a result of that legal precedent, effectively what happened was it was made illegal for councils to take out standalone swaps and derivative contracts. So the council was prevented from speculative financial deals to protect the taxpayer. And so effectively what happened after that was the banks found a way of engineering around those restrictions with the Hammersmith and Fulham ruling. But just to give it an idea of the sort of politics of the sorts of people we're dealing with here. So this guy here is Michael Spencer, who's the chief executive of ICAP. ICAP is the largest brokerage firm in the world. So what ICAP do, they sort of work between, they're intermediary between the bank and the local authority. So they arrange the transactions between these large clients like councils. And Michael Spencer just happens to be a major donor to the Conservative Party. So he was the chairman of the Conservative Party in 2009 before the election. And he was gifting around £1 million a year to Conservative Party coffers. And turns out that Michael Spencer's firm, ICAP, they had a subsidiary, a business unit called Butlers, which was also providing advice to local authorities on how to borrow money and where to invest it. And we'll talk a bit more about their role in a minute. But to give you an idea of, so I guess the most recent kind of, the best known scandal in local authority finance in recent years was in Iceland. So basically what happened in 2008-09 when a series of Iceland banks went bust, it was found out that £1 billion of council money was invested in those banks. And it turns out Michael Spencer's firm was the major player in giving the advice to the councils to invest in Iceland. And so a lot of councils like Kent, Barnet and London lost a lot of money, and some of them are still waiting to get their money back. So you can kind of see how much they lost. So Kent, 50 million, Nottingham, 41, Barnet, London, 27 million. And as you can see, the majority of that advice came from ICAP. In terms of, I guess, local authorities, how they're funded and how much debt they currently hold. So overall, the total stock of council debt is about £87 billion. And of that, if you look at the chart below, the vast majority, around 75%, is from what's called the Public Works Loan Board, which is a part of Treasury, part of government. Loans from the Public Works Loan Board generally come in the form of a fixed rate loan or a floating rate loan. Generally, they're at quite competitive rates, but what we sort of find is that the treasurer, whoever runs the chancellor, can actually kind of change the interest rates to the profit margin on Public Works Loan Board rates. But as a general rule, it's quite competitive. In terms of the work Debt Resistance UK has been doing, we've been looking primarily at the loans from private banks, LOBOs, which is about 14–15% of that total. One of the interesting things to look at is actually when a lot of this borrowing was undertaken. So this is simply a chart of, in blue, loans from the Public Works Loan Board to councils, and in red, the LOBO loans. And so I guess what you can see quite clearly here is an enormous spike in borrowing between 2003 and 2006-07, just before the crash. And what we sort of think was happening was that councils were taking out these loans at relatively low rates, 4 or 5%, and they were depositing a large chunk of that cash in places like Ireland, where they were getting Iceland, where they were getting 7 or 8% interest on that money. And so councils were being encouraged basically to speculate, taking out money at low rates, depositing it at higher rates, and starting to sort of act like a investment bank. And the major people who benefited from this practice were, of course, the banks themselves and the brokers and advisors in the city who were taking fees and charges on all these transactions. And 2008-09, when the financial system crashed, all this activity largely ceased. But you can sort of see from the bottom, the sort of LOBO loan market kept sort of struggling along until about 2012 when it stopped. Just to talk a little about the role of central government in encouraging the LOBO loan market. So councils effectively have 2 choices when they borrow. They can borrow from central government via the Public Works Loan Board, or they can borrow from a bank. Now, the councils are supposed to benchmark the cost of those loans. The finance officer in the council is supposed to look at it and say, okay, rational decision, is a loan from the government over 20 years going to cost me more or less than a comparative loan from the bank? And basically what successive chancellors have been doing, starting with Gordon Brown and more recently with George Osborne, what they've done is increase the interest rates on loans to councils from the government, which makes it comparatively better value to go and borrow from the bank. So central government has actually encouraged local authorities to go out and borrow from the city. I think there's a couple of reasons they were doing this. One, to help prop up the banks after the crash by encouraging government to borrow from them. And then I think, yes, secondly, because governments basically deem financial services to be a good thing, they want to encourage it. And so in a lot of cases, they prefer councils to be borrowing from banks because it gets the public debt down. The debt's carried by the bank, it doesn't show up in the government's accounts, so they look better. So there's a few political reasons for this stuff happening. So just to look at, I guess, how that sort of maps out. So In yellow here, we have loans issued by the Public Works Loan Board between 2006 and 2010. And in the blue, we have LOBO loans issued by the Royal Bank of Scotland. And what's interesting about it is after RBS was nationalised in 2009-10, you start to see a big jump in LOBO loans being issued by RBS. And part of the reason for that is because George Osborne increased interest rates at the Public Works Loan Board by 1%. So what that did, it made the cost of borrowing for a council from government 25% more expensive overnight. So at that point, a loan from RBS started looking like much better value for the council, and as a result, they sold more LOBO loans at that time. This just shows, I guess, a chart of the largest borrowers. You can't really see too much, I'm guessing, from where you are. But basically, we've got Newham Council and Kent at the top, owing between 450 and 560 million pounds each. This just shows the top 50 borrowers, which is down to Kirklees and Dorset owing around 50 million. So that just shows the largest borrowers. In terms of the issuing banks, the banks which have handed out the loans, by far the largest is Barclays. We've then got Dexia and Deptford, which are European banks, both of which were bailed out after the crash. In fourth place, we have RBS, succession of kind of European lenders. But what I also find interesting is that in this list, we also have institutions like Siemens Financial Services, which is an engineering firm. We also have British Aerospace Engineering, BAE, which is basically a military firm. So it's not even just banks selling these loans, it's also engineering and military firms, which I think is quite fascinating. So yeah, quite a sort of large variety of lenders, some of which are building societies like Stroud and Swindon. So not just all the large kind of investment banks you sort of think of. So just to talk a little about what a LOBO loan is and how it works. So LOBO stands for lender option, borrower option. Generally, they're ultra long-term loans, so between, let's say 40, 50, and 70 years. How they're typically structured is they have a short teaser rate, which is, say, for instance, if the government rate is 4%, what the banks will generally try and do is to try and sucker you into the deal by saying, we'll give you money at 2%, undercutting the government rate for the first 2 to 5 years. After that sort of 5-year teaser rate period, the rates then step up to a higher interest rate. But the reason the banks are able to sell so many of these loans is because the treasurer generally only looked at the first 2 to 5 years of the deal. It didn't really understand the risk at the tail over 50 or 70 years. So they kind of ignored the fact these were long-term deals. The borrower has the option, so the lender, the bank, has the option at regular intervals between, say, every 1 and 5 years to propose or impose a higher interest rate. The borrower, the council, has the option to either accept the new rate and pay a higher rate of interest, or they can repay the entire loan at around 2 days' notice. Again, analysis for LOBO contract shows that some of the councils, around about 12 or 14 of the councils, are paying between 7 and 8% interest on LOBO loans. The more standard, what they call vanilla rate LOBOs, the interest rates generally vary between 4 and 6%. The banks made enormous profits on these loans, so around about £2 billion upfront profit. So the day the loan was taken out, the bank books that profit. It pays bonuses to its salesmen. And so, again, the major benefactors of this market were banks and the brokers and advisors who recommended to the councils to take them out. We've brought a few examples of LOBO loan contracts in this yellow folder, so I can kind of show you a couple of them later on throughout the day. One of the interesting things about the loans is sometimes the kind of warning clauses which sort of pop up throughout the contract. So in red here, I'll just read it out. It says, please note that the nature of this loan is that the interest rate may increase at a time you may consider disadvantageous to you. So basically, at the worst possible time, the bank's got the option of increasing interest rate. Now, if this was a home mortgage, you probably read that and kind of think, you know, if there's a downturn, if there's a crash, you know, maybe I might lose my job. It's probably not a good thing that the bank's got the option to increase interest rate at that period. But I think part of the issue here is because this is other people's money, because the finance officer and the counsellors they don't ultimately have to pay these loans back themselves. It's taxpayers who pay them back for them. They're not too concerned about this. So they've kind of signed away these contracts anyway without really thinking through the consequences. So how does this look when you kind of chart a LOBO loan and the various components of it? So basically, this is a chart showing on the left axis, basically the interest rates which the council, in this case Brent, are paying the loan. So the blue here is the available public works loan board rate at the time, so about, let's say, 4.5% interest. So the bank salesman comes along and says, okay, we're going to give you a LOBO loan. This is RBS. And so what they do, they sell them a teaser rate, 2% interest. You know, it looks great for the first couple of years. This red line is basically what the advisor or the analyst sort of predicted that loan might cost after the teaser rate period expired. But basically what happened was that interest rates stayed low. So, you know, the Bank of England rate is still at 0.25%. We've got historic low rates. And so because of that, the actual interest rate the council's paying is shot up. So they've gone from paying 2% for the first couple of years up to paying around 7%, where it's basically stayed since. And so effectively that council could have got money, you know, around about 2% cheaper had it simply borrowed from Public Works Loan Board. And so what you basically get here is financial salesmen encouraging local authority treasurers to take bets on interest rates. So very similar situation to what we found with Hammersmith and Fulham. And basically they've been able to get away with this because what they've done, rather than getting the council to take out standalone derivative contracts, they've issued the council a loan, but with derivatives inserted inside the contract. So they've found a way to engineer around the legal restriction.
There's another important difference with Hammersmith and Fulham, which is that Hammersmith and Fulham did actually have a chance of winning the bets.
Yeah.
They were betting on the toss of a coin, and if the coin went one way, they were going to win, and if it went the other way, they would lose. Under the LOBOs, the council has no chance
of winning the bet.
Because if the coin goes the council's way, the bank can just take it away. So it's very different. It's like a derivative.
Yeah.
But worse than a derivative.
Yeah. Okay, so just to give you an idea about why the councils took out these loans. So one important point to note is that it's not just the finance officer at the council who ultimately makes the decision on these things. The council also has external financial advisors. The main players in this market were Butlers, which was a subsidiary of ICAP, Michael Spencer's firm I was just talking about. The other major player in this market was Sector, which is a subsidiary of Capita, the largest outsourcing company in the UK. Capita were the financial advisor to around 70% of local authorities, housing associations, universities. So Capita is by far the biggest player in the financial advice market to councils themselves. And this is basically a screenshot of Capita's website. There's a brief disclosure which came up, and Capita were marketing themselves to the councils as independent financial advisors, i.e., you know, we're trustworthy, we're going to act in your best interests, we're good guys. What this says was actually unbeknown to the council in a lot of cases, the Capita were taking kickbacks, commissions on the loans from ICAP, Tulloch Brabon, when the council was borrowing via LOBO loans. So rather than giving objective advice in the client's best interest, Capita was simply trying to maximize their own revenues by encouraging councils to go to the banks. So rather than a kind of functioning market where everyone kind of knows what's happening and there's sort of transparency, what you get is basically a situation where everyone's conspiring to shaft the local authority and the taxpayer. So you get Barclays, Dexia, Deptford, RBS and all these guys. A local authority wants to take out a loan. In the middle, you've got the broker, you know, ICAP, Talent Pro Bon. The local authority pays a fee to the broker. The bank also pays a fee to the broker. And in the middle, you've got the Treasury Management Advisor who's supposed to be giving objective advice to the council. The council is supposed to be able to trust them, but hang on a minute, they're being paid a kickback from the bank and the broker. So basically, it's a market where there's, you know, abuse and what I would describe as fraudulent conduct going on. But because it's unregulated, the Financial Conduct Authority who are supposed to regulate the space basically just shut their eyes to this. Because it's not regulated or enforced, the banks and the brokers are able to get away with it. So sort of sad state of affairs, but that's where we are. And so basically what you look at to understand how those kind of dynamics, the relationships between the broker and the advisor sort of play out, where the advisor is Butlers, the parent company ICAP, broker around 84–85% of deals. And bear in mind that this is supposed to be a competitive marketplace. There's supposed to be competition between all these different firms. And so you've got a complete monopoly. Where the advisor is Capita, Talent Pro Bon, who are paying Capita a kickback, they brokered 68% of deals. So again, not a competitive market, it's a closed shop. And so who are some of the individuals involved? So we spoke about Michael Spencer. Here we also have the current Defence Minister, Michael Fallon. He was on the board of Talent Pro Bon, the brokerage firm, making millions of pounds of profit. On the right, we have a woman called Angela Knight. Who's she? She was formerly the head of the British Bankers Association, which was the lobby group for the banks, and she's also on the board of Talent Pro Bon. So very highly connected individuals. Angela Knight is also currently working, I think, at HMRC on tax issues. Now, how much were local authorities sort of paying to the brokers and advisors? So on the right-hand column, this is for Kent County Council. You can see the brokerage fee for each LOBO loan they took out. So over a period of, say, 5 years between 2007 and 2011, Kent County Council paid over £1 million in fees alone on these LOBO loans. And bear in mind, at the same time, the broker was getting paid from the bank. So these salesmen made enormous profits at public expense. And who's watching all this? This is Eric Pickles, the former community secretary. He shut the Audit Commission in 2015, which was an independent government body, which was supposed to look at public spending, make sure taxpayers weren't getting ripped off. Pickles shut the Audit Commission down as part of the austerity cuts. And so that audit function has now been outsourced to the big four accountancy firms, KPMG, Deloitte, PricewaterhouseCoopers. And these big four audit firms, of course, also audit the big banks who sold the LOBOs, creating conflicts of interest. So what you basically find when you look into this is, why did Pickles close the Audit Commission? Well, because the accountancy firms made enormous donations to the Tory party ahead of a 2010 election, and they could see they'd make large profits by providing auditing services to councils. So rather than the Audit Commission operating, you've now got these Tory party donors, audit firms, and they're making significant profits by basically covering up mis-selling and outsourcing activity at councils. So I mentioned Debt Resistance UK did some work with Channel 4 Dispatches on exposing this issue. A couple of the people who were featured in the documentary, at the top you've got Abhishek Sakdev, who runs Vedanta Hedging. He gave some expert opinion to Channel 4 on what was going on. As Nick mentioned, he described these loans as a lose-lose bet for local authorities. They weren't really told about the financial downside they were exposing themselves to. The other guy who features is Rob Carver, who's a former Barclays banker who actually sat on the desk which was actually pricing these loans to councils. And we're going to show you a brief clip of the Dispatches program. Looks promising.
officer has spotted something strange in Cromwell's accounts. Bank loans totaling almost £400 million.
I was very much struck by the way a lot of very long-term borrowings at quite high rates. So it seems to me there's a great leakage of money out of the council.
What was your reaction when you saw the type of rates that they were paying?
In one particular case, there was even 7%, more than
7%?
7%. 7%, yes. I was totally appalled because a local authority would expect to pay a very low rate of interest, and base rates are almost nothing just now.
Many of the loans go by a name that's new to me and to her, LOBOs.
These council officers thought they were getting a good deal. They were getting a low teaser rate, and it was working like a normal fixed rate mortgage. But they didn't understand that actually this was a lose-lose bet for them, and that if interest rates went down, they'd be faced with crippling breakage costs. And if interest rates went up, the banks would increase the rates. LOBOs are costing councils millions of pounds of extra interest because they're paying higher interest than they would be if they could go out and refinance or at lower rates.
Just a quick day, Dispatches, this is a program on Channel 4. We're doing a program on council authority loans, right? Europe, have you heard of a LOBO? No, not many people have. These are loans that local authorities take out with banks, and Europe's got quite a lot of them. It's got £563 million, and we're only suggesting interest rate they pay on these loans. Now, what type of rate do you think you would expect a local authority to pay? I would expect it to be less than 1.5%. Would you reasonably expect it to pay? Yeah. 5.5%. Okay. Just have a guess. 2%. Okay. Would you answer? Okay. Just write it down there. They're actually paying up to a rate of 7.6%.
Oh my gosh, that's a lot. Yes, I'll be asking the question, why? Why is it that rate?
7.6%. Yeah. That's versus the first loan.
That's scandalous. Absolutely scandalous.
Could you justify how you're charging councils, some of the poorest in the country, high interest rates on complex and risky loans called LOBOs? Some of these rates are as high as more than 7%.
Well, it's very difficult to talk about specific interest rates attached to specific asset classes. Rates go up and down. Sometimes we quite well with interest rate spreads, and sometimes we do when we can't. That's also the nature of banking. So I don't think we don't have any mechanism for separating out councils.
Between 2002 and 2004, Rob Carver was a junior trader for Barclays Capital on the exotic interest rate derivative desk.
I don't deep moral qualms about the local authority trades.
Deep moral qualms. To explain what those qualms are.
I didn't feel that the trading we were doing was fair. I didn't feel that they understood the business that they were getting into. And I didn't think ultimately it would be a very good deal for the local taxpayers of that authority.
Why have you decided now to talk out publicly?
The local authorities are in a very difficult situation at the moment. Cuts the central government's making to their funding means they're having to cover all of the central services. But they're still stuck paying these very high interest loans that they can't get out of. That's what we have quite serious effects.
Time to play the Dispatches LOBO game. This time, in Walsall. Okay, right. We're doing a programme on council loans. Also took out a loan for Barclays, called a LOBO, for £15 million. What profit do you think Barclays made on that loan on the first day?
On the first day?
Yeah. £10,000. So just put your answer there. £6,000. The answer is 1 million. Okay, that. So, do you have the answer? 15,000. Well, the answer is 1 million. Yeah, first day. Did you get that?
Oh, fabulous.
Based on the financial analysis that we've done on these £5 billion worth of loans, at the time the bank sold them, we think the banks made anything between £300 to £500 million of profit.
That's a lot of money. And we know that nationally there's about £15 billion of these LOBOs taken out. So we're talking nationally
At £1 billion of profit.
£1 billion from lending money to local authorities.
And was so just, I'll just try and push through this quickly now, so we can crack on. But just sort of point out, while there is a financial regulator, in this case the Financial Conduct Authority, who is supposed to regulate banks and financial institutions, they basically take a view that councils are what they call sophisticated borrowers. They should know what they're doing. And so the FCA kind of just washed their hands of the fact that this mis-selling by the banks has been happening, and they refused to investigate it. So basically what happened after dispatches was that Clive Betts MP, who's a Labour politician, he is the chair of the Local Government Select Committee. They briefly announced an inquiry into this issue. A couple of people, including Abhishek and Rob Carver, presented to that committee, which was about just over a year ago. So they had one hearing and then basically didn't do anything to follow up. There was no report. They took evidence from a handful of people, and effectively it's gone nowhere. This guy is Andrew Tyree, who's the chair of the Treasury Select Committee, who basically create financial policy to regulate the financial sector. They've also had an initial look at this, but again, we haven't heard anything back, and it's not clear what's happened in the sort of past 12 months. So I guess we're at the point now that the regulator and the governments don't seem to be doing much, that we're starting to look at options for legal action and for empowering local people to take action on this issue themselves. Basically, that's happened over the past 12 months in the form of Audit Commission Act objections, which Simon was talking about in relation to Lambeth. What we've done at Debt Resistance UK is helped about 20 people at councils around the country, including Newham, put in objections to their accounts and saying we think the borrowing was irrational, potentially illegal, and we want the auditor and hopefully the High Court to take a look at it. That then goes through a process where the auditor does an investigation, prepares a public interest report, and we sort of hope it may result in some of these loans being declared illegal, but it's certainly not guaranteed. So we can sort of talk a bit more about this this afternoon, but currently it's been, so 12 months without sort of hearing too much back from these councillors where there's been objections made. And so over the next sort of 6 months, as we come into the audit objection window in the summer this year, we'll be encouraging more people to put in objections to their council and to try and increase that number from 20 up to, we sort of hope to catch, the top sort of 50 LOBO borrowers at least. So yeah, just in terms of, I guess, the politics of what we're doing to wrap up, the citizen debt audit is not an attack on local government. So I think our analysis of the problem is that, this is about reclaiming democratic institutions like councils that from the clutches of the financial sector. So we think, the fact LOBO loans have been sold to councils is an act of mis-selling. So we're not here to kind of blame the councils, but to sort of help them try and recuperate public funds, which should be funding social services. So perhaps, Vika, if I just hand over to you now to sort of talk about.
Do you have one more slide?
I think this is yeah.
Okay, that was a lot to take in if it's a producer Sunday. Does anyone have some burning questions? We can then maybe go more into, have smaller conversations afterwards if there are parts you didn't understand. But if they're like, you take the three questions as well.
Not so much a question, just a comment. I mean, that was a brilliant presentation, and I think it's really important to highlight, because with the austerity cuts, a lot of councils now are being encouraged to invest, to make up the shortfall.
Yeah.
And they don't really have the skills to do it. I mean, there was something, I think, Worcester this week decided to invest 30 million taxpayers' money on a share of a bank. And I tweeted it recently. They've got something like 100 million LOBO loans.
Yeah.
So they've already been ripped off once, they're already getting ripped off again. So I think the second point is also, I think austerity is also, I mean, what you showed on Newham about 50 million there, 50 million cuts. I think it's a convenient excuse for a lot of councils as well.
Yeah.
Blame everything on government. Yeah. So.
I think it's, yeah, I mean, just very briefly on Newham, I mean, a guy I sort of follow on social media, he was tweeting out, so the mayor of Newham Council, Robin Wales, he's been in power about 14 years, but when he was elected, I think it was mid to late 90s, his policy manifesto actually had an explicit objective of basically forcing out poor people from Newham Council in order to jack up property prices. And so actually look at what's happened in Newham, so like since about 2000, property prices have gone up about 400%. The number of people who own their home has basically, so you got basically I think 2 or 3 times increase in the number of people renting. And obviously the homelessness issue has just exploded. So rather than it being necessarily, I guess, a consequence of government austerity, in the case of Newham, it's been very much explicit policy to try and gentrify the borough. So I think for a lot of councils, austerity is a bit of a convenient excuse, as you point out.
Yeah, I just wanted to clarify. So Clive Betts and the local government committee, they gave no reason for dropping the case.
Yeah, so well, technically they haven't dropped it. It's still open. They're just not doing anything. So I spoke to his assistant on the phone about a year ago and asked what was happening with it. He said, effectively, they can't do anything. It's a Treasury problem. Go and talk to Treasury. We've done that. Treasury have also not done anything. And so I think, yeah, they sort of see it as an issue for the FCA and for the Treasury Select Committee to resolve, and sort of wash their hands of it. So I don't think there's much scope of community, CLG committee doing much again. I think maybe there is some scope if, say, for instance, housing associations start pushing back on this as well. If maybe more councillors start complaining about it or take legal action, they might be forced to do something. But at the moment, because as Nick mentioned, neither the councils or the banks really have a vested interest to tackle this issue, because the councils don't want bad publicity if this was made public that are being missold. I mean, they just don't want a scandal on their watch. So unfortunately, at the moment, there's nothing much has happened, and it's sort of waiting for basic citizens to get involved into, to force the issue.
Yeah, normally you have the government giving out certain grants.
Yeah.
Right. And then you have the council basically, like the money given council tax being spent on services for the homeless situation. Is there no way to increase the amount of money that being given away to the council? That makes sense. So that they can start borrowing. You mean the grants? Yeah, basically increase the amount of grants that are being given by the government. So the council doesn't have to borrow banks.
Yeah.
That's not.
I mean, yeah, it's a political choice. I mean, the government could say, we're not going to fund defence, we're going to fund local authorities and social care because there's a crisis in the NHS and, people need care in communities, they need housing.
Yeah.
But they're making a political choice not to do that. So there is money, it's a question of where it goes. And yeah, I mean, government could also decrease interest rates at the Public Works Loan Board and make it cheaper for councils to borrow from government. They're not doing that. That's a political choice. So they can even
basically saying borrow the money or not.
Sorry?
Are they basically saying you have to borrow the money or not?
Yeah, well, they're basically, they've just committed. I mean, local authorities continue to be, their funding each year is cut. And, they're told, government comes back each year and says, we want you to make more cuts. I'm not sure if you saw it, but last year there was this issue in like David Cameron's constituency where, this is, a relatively well-off Tory shire in Oxfordshire. And David Cameron was like, well, we want you to sort of like cut, make another 10% cuts. Why don't you just get rid of some people in the back office and sack a couple of people? They said, look, I mean, we've basically made every cut we possibly can. If you cut us anymore, we'd have to close schools, children's centres, libraries. Like, there's no more easy cuts we can make. And so we're at a point now where basically, as I mentioned before, councils are on the verge of bankruptcy. You've got councils like Barnet who have basically outsourced all their operations to a company like Capita to try and save money. And government is not doing anything about it. So they know the scale of the crisis. It's a political choice to let it continue. And so I think, yeah, it's if they wanted to, they could both increase grant funding and they could make it cheaper for councils to borrow from government, but they're not doing that. And so yeah,
just to add to that, like what central government is trying to do is like to reduce the debt on the central government balance sheet. So like at an international level, it looks okay, but then it doesn't really matter what happens to the local level. So if councils get more debt too.
Yeah, that was what I was going to ask. To what extent does it reduce that appearance of debt on the government's balance sheet? How much are they advantaging from it in terms of?
Yes, I mean, in terms of these LOBO loans, I mean, the amounts that they borrow from the banks is about 15 to 16 billion. So, in some measures, I mean, the accounting, basically this, whether or not the loans are on the government's balance sheet is driven by accounting rules. So it's about, a lot of this activity is driven by incentives written into the accountancy system to try and drive down public debt. And so as an example, another example of this, there's another type of loan which public authorities take out called a private finance initiative, which funds basically a way of funding hospitals and schools. Through that scheme in the last 2 decades, the UK government's committed to about £320 billion of infrastructure. And the whole reason PFI exists was to get that debt off the government balance sheet. So if you include PFI on the government accounts, the amount of debt increases by like 2 or 3-fold. So yeah, there's been incentives written into the system to make it look like government's been prudent and they're not borrowing. But what actually happens is, rather than borrowing at low, stable, cheap rates, they go to high cost credit from the banks, take on more risk, and eventually it kind of blows up and we end up paying far more over time.
That's a bit problematic because if it's not on the balance sheet, there's no way we can show it.
Well, I think, Nick Stoop is here, who's a financial analyst and a kind of expert in this stuff. So probably, let's have a conversation with Nick about the kind of how the liabilities increase off balance sheet and at some point have to be kind of brought back on. But effectively what happens is when the council or the public authority takes out these loans, they take on board a whole bunch of financial liabilities, which are depending on market conditions like interest rates. And if rates go the opposite way to what the council thought, their liabilities can significantly increase. And so the issue is that the council takes, or the public authority takes on a lot more risk than they would be if they borrowed directly from government. And so often it's both the case they pay more interest, and for instance, they have to break the loan contract, they have to pay an enormous breakage cost, which would cost them even more money on top of it. So it's a combination of the fact that it's not transparent, it's higher risk, and there's large break costs which are built into these private bank contracts.
But from my point of view, if there was a way to show simply that's better, sort of visualize the data.
Yeah, I mean, I think it would be good. So one of the things we're trying to do is, provide illustrations of council accounts in a way where all the sort of borrowing is much more simple to understand than it is currently presented. So rather than a couple of line items which are hidden as appendices to the council's report, providing sort of pie charts and illustrations which kind of show how much is actually owed into home. So we think it helps.
Yeah, maybe we can go more in depth on this topic, like in smaller groups afterwards. But you'll see also from what I'll be showing you now how it's very much about how actually local government present the information and central government present the information. So one thing is like what's written on the loan, one thing is the actual debt and a prediction of it. So if you've got energy for another, I think 5 to 10 minutes, and then we'll have a break.
I just need to find the right slides now.
While the guy's looking for a slide, can I just say a technical point about the break we're soon about to have? We haven't got like an infinite amount of paper cups, so we'd massively appreciate if you could sort of try and, I've got a few sharp if you want to even just like, I don't know, write your name or draw something on yours so you can't even like, it's not the end of the world if you lose it, but I do not have a new one for every coffee.
Can you, okay, can you check if on the live stream, Joel, I don't think it's showing. I don't know. Yeah. Sorry. Let me just do this. Hello. Okay, that should work. And Chrome.
Yeah, slightly.
Okay, cool. So I'm just going to explain briefly like what we had in mind for the day. So for communication channels, we actually have like around 4 people that are following remotely. And we've set up what is, I don't know how many people use Slack, but we have a Slack channel, which is basically a chat channel that you're welcome to join. And that's where like we can, like when we're all working on stuff, we can sort of chat and ask questions, but we can also do it face to face, but the people online can't. If you, this document here is that you can find it at this address here, and it will be, I'll leave it up on the screen, but it will have all the links that you'll need for the day. You'll find a link to our website that has quite a lot of information, and also to the booklet that you have on the tables, but at least you can share it in the future if you need it. So we've put down some ideas of possible tasks that would be useful today, but these are just like suggestions. You're welcome to do other things. This one in particularly is like the thing that we need most help with, because as Joel was explaining, we've sent FOI requests to like more than 200 councils, and what we receive back from them are PDF documents, and we need to translate these PDF documents into spreadsheets. And so here I've like explained a really like step-by-step how this can be done with examples. So there's a guide on how to do it, and examples. Basically what we want to do is translate into each contract into a line in a spreadsheet, like here. So it's not very exciting, but it's really, really useful. And you can see how already here we can start seeing how like the treasury management company is a subsidiary of ICAP, and that you have the brokers that are also a subsidiary of ICAP, and how we can start looking at the various interest rates and so on. And this then translates into a much bigger spreadsheet where, let's see if this is going to work. So these are the ones that we've already done. And so this, if anyone wants to work on the overall data, this is the data for around 80 councils, and you can start comparing, looking, you know, doing percentages and so on. And we've also got a tab for the Scottish councils and the London boroughs. So just going back to, so the first task would be translating from the contracts to the spreadsheets. And even if like each of you managed to do 2 today, that would be already like a massive step forward for us. Then there are like some broader data sets. Now, just bear in mind that like these are draft data sets, like don't use them publicly. We still need to go through them and check that everything is correct and so on. But you can start using them to imagine how you could visualize this data in the future when the data set is complete. We've also pasted other data sets that we think could be useful to compare. But also if you come across other data sets that you find online and so on, it would be great if you could paste them into this document. The other thing that like I've personally found very interesting is just like selecting one council and being like, okay, this is my council. I mean, I live in Hackney, and Hackney actually doesn't have LOBOs, so I can't investigate my own council. But just choosing one and being like, okay, I just want to understand the details of this council, and doing investigation on who the Treasury Management Advisor was. You can go on the council's website to look at their accounts. We can help you like understand how the accounts work, how you can read them, and so on. And also like starting to map out who were actually the people responsible. So sometimes the contracts actually have signatures on them, and so on. And then the other thing is that, like, obviously it's a complicated issue and so on, but like something that we really need to work on is translating it in a way that actually people who don't have understanding of finance and so on can understand it. So if anyone has like good ideas of how this can be translated, that's also very welcome. But again, these are just suggestions. Like we had a hackathon like, I don't know, 6 months, nearly a year ago. And, you know, there was video artists who said, oh, I could do a video like this. Or they were like, everyone, according to like what your skills are, what your interests are, just work on whatever you're interested. I think that's all. I would say, should we have like a short coffee break? And then just as groups, like I'm going to be working on the spreadsheets and data entry. So if you're interested in doing a bit of that, I'll probably sit here. So just come and join me. Well, get hold of Joel if you want to go a bit more into detail about the finances, maybe with Nick. And I don't know, Fanny, if there's something in particular you want to be working on. But yeah, just basically get hold of us, ask us questions, and yeah. And we're gonna, I think maybe we have a coffee break now. We start off for an hour, and then we'll have, we're gonna go and get some bagels and we can have lunch together here. That's okay. Cool, thanks.